Hey guys, in today's video we're gonna discuss what a relative strength index is, or RSI. Have you ever been running on a treadmill and reached that point where your body says, I can't keep this pace anymore? The relative strength index, or RSI, works kind of like that, but for the market. It tells you when a price has been running too fast in one direction and might need to slow down or reverse. RSI stands for Relative Strength Index, and it's one of the most popular momentum indicators in trading. It measures how strong or weak price movements are, helping traders spot potential reversals before they actually happen. Technically, RSI is a formula that compares recent gains to recent losses over a set period, usually 14 candles, and scales it on a line from 0 to 100. Now, here's what those numbers mean. When RSI goes above 70, the market is considered overbought, meaning price has gone up too fast and buyers might be running out of energy. When RSI goes below 30, the market is considered oversold. Price has fallen too fast and sellers might be getting tired. Think of it like stretching a rubber band. You can pull it only so far before it snaps back. RSI helps you see when that rubber band is stretched too much in one direction. Let's bring it to a simple example. Suppose Euro USD has been climbing all week. On your RSI indicator, the line reaches 75. That's a warning that the market might be overbought. It doesn't mean it will instantly fall, but it's telling you momentum is slowing. Now, imagine price starts to drop and RSI falls below 70. That's your early signal that buyers are losing strength. Now, let's flip the script. Price has been falling hard and RSI drops to 25. That's an oversold signal. Sellers have pushed too far and a bounce might be coming. If the RSI then rises back above 30, it's often the first clue of a possible recovery. But here's the important part. RSI is not a magic crystal ball. It doesn't tell you when the market will return. It shows you when the momentum is stretched. You still need to combine it with structure, support and resistance, and other confirmations. Think of RSI like a fuel gauge. Just because your tank is full doesn't mean you stop the car. It means you know how far you can go before refueling. Overbought and oversold readings are warnings, not trade signals on their own. Now, here's where RSI gets really interesting, with divergences. A divergence happens when price and RSI move in opposite directions. For example, if price makes a new high but RSI makes a lower high, that's a bearish divergence. It means momentum is weakening even though price still looks strong. On the other hand, a bullish divergence happens when price makes a new low, but RSI makes a higher low. That shows sellers are losing power. Momentum is fading and a reversal might be near. Think of divergency like a singer hitting high notes while their voice gets weaker. You can't tell they won't hold the note much longer. RSI shows you that same loss of strength in price. Now, traders use the RSI in different ways depending on their style. Scalpers might use it on the 1 minute or 5 minute chart to catch a quick reversal. Swing traders might use it on the 4-hour or daily chart to find exhaustion after big moves. Position traders might use it to confirm long-term shifts in momentum. A good tip for using RSI is to look for confluence. Combine it with areas of support, resistance, or trend lines. For example, if RSI is oversold and price is touching a key support level, that's stronger signal than RSI alone. Another advanced way to use RSI is to spot hidden divergences, where momentum confirms continuation instead of reversal. But for beginners, mastering the basic idea, overbought, oversold, and regular divergence is more than enough to start making sense of market momentum. And remember, RSI is all about the context. In a strong trend, the RSI can stay overbought and oversold for a long time. That doesn't mean it's broken, it means momentum is powerful. If you trade against it too early, you might step in front of a moving train. So let's recap. RSI measures momentum from 0 to 100. Above 70, overbought. Below 30, oversold. Divergences warn of fading strength. Always confirm with price action and structure. In other words, RSI doesn't predict the future. It helps you read the energy of the market, like a fitness tracker for price. It shows when the market is sprinting, when it's tired, and when it's catching its breath. So, in short, RSI is your way to measure the market's heartbeat. Learn to read its rhythm, and you will know when the market's running strong and when it's actually out of breath.